Just looking at the pound, and it's ticking every second.
Lowest value ever.
It essentially diagnoses that we are already in a recession that could really be quite protracted.
Because it's a joke, isn't it? If you'd written it as a sitcom for telly.
I am a fighter and not a quitter.
The UK is experiencing the worst economic collapse in over 40 years. Energy prices are soaring. The bond market is collapsing, causing the rest of the economy to crash as well. Housing, pension funds, cash, cars, education, and banks are all in trouble now. The situation is so horrendous that the International Monetary Fund has openly attacked the UK's economic policies. According to a BBC report, inflation was over 10% in September. Food prices are rising at their fastest pace in more than 40 years, all while wage growth is lagging very far. Behind this is when the government is supposed to step in and help the struggling population. But the new administration has been so incompetent over the last month that the Prime Minister was forced to resign 45 days after being elected. If you had told me all of this was happening in a country, I would have guessed it was in a developing nation that's still figuring stuff out. But no, this is happening in the United Kingdom, the world's fourth largest economy and historically one of the most stable countries in the world. Because of excessive money printing during the pandemic, inflation in the UK has soared to a 32-year high of 8.6%. This is hurting the purchasing power of UK citizens and is, as a result, slowing down the economy. Under Johnson, the UK's economy was already struggling when all of a sudden Russia's invasion of Ukraine pushed all of Europe, including the UK, into chaos. In a lot of ways, the UK's economy is not unique when compared to other European nations. It's facing all the same issues like rising inflation, skyrocketing energy costs, and a tight labor market, but it already had a big issue that it was dealing with even before all this started, and that issue was Brexit. For those of you who don't know, the UK voted to leave the European Union in 2016. This vote was nicknamed Brexit after the vote succeeded. Both parties slowly set out a transition plan to break up, and by 2020, trade between EU and the UK had slumped to its lowest point after Britain formally exited because of Brexit. It was forecasted that the UK economy would shrink by 4%, as the economy was already struggling. The pandemic and Russia's war only made things worse for UK citizens. The entirety of Europe is facing an energy crisis, as Putin has turned Russia's oil supply into a strategic leverage. Against the sanctions, things are about to turn dire as winter approaches and every country's energy demand is about to go through the roof.
Liz Truss has been named the next Prime Minister of the United Kingdom.
Liz Truss is set to take over as Britain's next Prime Minister today.
Liz Truss is elected as the leader of the Conservative and Unionist Party.
Well, thank you, Sir Graham. It's an honour to be elected as leader of the Conservative.
On September 23, Liz Truss and her Chancellor announced a new policy called the mini-budget. Unbeknownst to Truss at the time, this was one of the worst policies in modern history. The mini-budget aims to lower tax rates to boost the annual growth rate of the UK back to 2.5%. Truss believes that the only barrier that prevented the UK economy from rebounding was the UK's taxation on the rich. This was a horrible assessment by Truss for numerous reasons. Lowering tax rates not only exacerbates inflation, but also increases government debt. The mini-budget is expected to increase net borrowing as a percentage of GDP from 5% to almost 8%. That's a frightening increase that puts the UK in a much more awful situation than before.
Now, the British pound has fallen to its lowest level ever against the US dollar.
Just looking at the pound, and it's ticking every second.
Currency collapse, soaring borrowing rates, investors and businesses in despair.
The British pound hitting an all-time low today against the dollar.
Debt to GDP in the UK is high.
This rate just has been increased to 3%.
Investors were selling pounds for a more stable currency, like the US dollar, at a record pace. The bond market was completely upside down because of this massive sell-off. So let's quickly go over how bond prices work, as this is crucial to understand the extent of the financial crisis in the UK. Whenever someone like the government wants to borrow money, they usually issue bonds with a set expiration date and interest rate. Let's say the government issues a bond with a 5-year expiration date and 5% interest. So if you invest $100 in these bonds, you will get $5 every year in interest payments for 5 years, and at the end of the 5 years you will also get your $100 back. Now, similarly to the stock market, there's a bond market where people and institutions trade bonds just like stocks. If there's a lot of people who want to buy a bond, then the prices of bonds go up, and vice versa. But remember, the interest rate doesn't change, as that's set by the issuing party, which is the government. In this case, so if there's a demand for your 100 bond, then you could sell it for $200. Now the interest payment is still $5, which is only 2.5% of the bond price. So as the price of the bond goes up, yield goes down, and as the price goes down, the yield goes up. Now in the UK situation, a lot of investors wanted to sell out of their pound-denominated bonds. This pushed the price of the bonds lower and yield higher. Once people sold their bonds for pounds, they then sold the pounds for other currencies, pushing the value of the pound lower and lower, and the crash of the pound only made things worse for citizens. As imports like energy will become more expensive, now that these higher costs will most likely be passed on to consumers unless
very worried about is the use of derivatives, the use of coping strategies for the pensions industry that did not necessarily have all the assets it would need to cover its liabilities as well.
Talk about too big to fail. I mean, UK pension funds effectively are that to the UK.
So a lot of people outside the pensions world have been quite surprised to find that so much kind of debt, if you like, has been accumulated by pension funds.
I've been getting into trouble recently for referring to pension funds as a form of shadow bank.
Pension funds are holding the gilts, they're holding the liability-driven investment, LDI funds, as a hedge against their liabilities. So all of last week, you had gilt yields going up, liabilities are coming down. So this should have been a great story. And even as early as, the Friday of the mini budget, you had this almost dream scenario in some ways for pension funds where their liabilities were just coming down so quickly, they were getting so much better funded, and just really quickly that dream turned into a nightmare.
the government comes up with a more competent plan. Decline in the value of the pound and rise in bond yield also set off a series of events from the financial sector that threatened the whole UK economy. Most dangerous of all was the pension fund crisis. This pension fund crisis has the potential to turn into something bigger than the 2008 crash. What does all this mean for the housing market? Mortgage lenders have scrambled to keep up with wild swings in the sterling funding markets that determine the mortgage rates they offer to homeowners. Some lenders temporarily stopped issuing mortgages to new customers, and others ramped up repayment rates for new loans to levels likely to stretch millions of existing homeowners and make new mortgages unaffordable for many others. Mortgage deals for new customers now feature rates at around 5% to 6%, a steep increase from the norm of around 2% for the last 5 years, which is prompting rising concern of a collapse in the property market further down the line.
Months ago, Buckingham Palace announced the death of Her Majesty Queen Elizabeth II.
And look at this. This is the national debt.
The cost of everything that we buy is going up at the fastest rate for 30 years.
So our shopping habits are changing, priced out of normality.
Can I just say to him, when he has been lecturing us about democracy, we will have none of it.
To make matters even worse, the UK is dealing with an international crisis. The UK is currently trading like it's an emerging economy because it practically is one. The country is currently in a considerably large twin deficit. When a country's current account is in a deficit, this means that the country is importing more than it is exporting. In simpler terms, more money is leaving the country than entering the country. The UK's current account balance as a percentage of GDP is currently at an all-time low of -8%. That's a terrifying percentage that is putting substantial pressure on the British pound. The pound-to-dollar exchange rate is currently at a 37-year low. The UK not only has a current account deficit but also a fiscal account deficit.